Good morning and welcome to the Chapter Zero event on access to capital and the low carbon transition. I'm delighted to see so many people on our call and pleased to thank London Stock Exchange for hosting this event for us and Aviva for all the work that they've put in to help us develop the content for it. Just a couple of housekeeping points, if I may. We would ask you not to do any live tweeting from the event. It will be recorded. And you have a Slido view on the left-hand side of your screen, which you will be using for some polls that we're going to conduct during the session. You can get rid of it by clicking on the little X at the top right-hand corner if it's in your way, but otherwise it is useful for posting questions. And we're happy for you to post questions at any time. They will get fed into the Chapter Zero team, who will then feed them to our speakers. So the questions we want to answer on this webinar are: why is it important that the board considers climate change as it relates to access to capital? It's such an important issue for all companies and is going to become increasingly so over the next decade. And how can corporates prepare to respond to the needs of investors and asset owners in that question, when answering that question? And finally, what to expect from our regulators in the coming years, because this is a topic which needs to be tackled immediately. It's not a 30-year topic. So if I may, I'll ask our speakers to introduce themselves and we'll go around the room, starting, if we may, with Steve.
Took me a little while to unmute. Sorry, Julie. So it's a real pleasure to be here, Julie. Thank you so much for the invitation. An honour to be on this panel, and huge kudos for everything you've achieved with Chapter Zero, an incredibly important institution. I'm on the task force for climate-related financial disclosure. It's been an honour to serve on it since its inception in 2015. But my main day job is the Chief Responsible Investment Officer at Aviva Investors, where I've worked since 2006. So I've seen an enormous number of changes, but I've known David for even longer than that, and Sarah for slightly less time. But the amount of change that we've seen and that we hope to convey, I think should be very vivid by the end of this session. Back to you, Julie.
Thank you. And Sarah, could you tell us about yourself?
Morning, everybody, and thank you, Julie, and thank you, Chapter Zero, for your leadership on this vitally important topic. I'm Sarah Breeden. I'm the Executive Director at the Bank of England, responsible for all of our work on climate change. Governor Carney, as he once said back in 2015 that climate change was the tragedy of the horizon. By the time we realised we wanted to do something about it, it would be too late. Our role as regulators is trying to get people to stretch their horizons. I think Chapter Zero are doing a similarly brilliant job of doing that as well. And I'm thrilled to be here. Julie, back to you.
Thank you, Sarah. So if we just think a little bit about the format of the event, we're hoping this will be very interactive and informal. We're delighted to get your questions, so please feed them through whenever you would like to. We're doing short talks and an extended panel session, so you won't be sitting in front of your computer listening to long presentations. It's going to be an interactive discussion, and I'm really looking forward to hearing what the panelists have to say. David, I think I missed you in the introductions, so would you tell us about yourself now, please?
Oh, no worries at all. Yeah, so I'm David Harris. I'm Head of Sustainable Business at London Stock Exchange Group. I also work across our Information Services division, FTSE Russell. It's a great pleasure hosting this event, and as the other panelists have said, Chapter Zero is doing such important work. It's critical for for boards to engage on this issue, and so really delighted to be hosting you.
Thank you, David, and thank you to all our speakers for taking part in this. They've put a lot of work into preparing, and Chapter Zeros and our members are really grateful for you being with us today. So before we actually start the full session, we thought we'd try a poll. This could be where it all goes wrong, but I'm hoping that that it won't. So we have a couple of questions for you now and a couple later in the session. And it's really to try to establish, first of all, what's driving change, corporate change on the climate agenda. So if you would open your Slido panel and click on the poll tab and start to vote on the question that you can see hopefully below. And in case anybody hasn't managed to get it open, just so that you're aware of what people are voting on, the question is, which of the following do you think will be most influential in driving the low carbon transition? Will it be consumer behavior, employee perception, investor pressure, increased regulation, or company law? So if you would fill in your votes, I would be very grateful. And the votes are coming in thick and fast, I have to say, which is excellent. So I will give it 10 seconds, Karen, at Chapter Zero, and then we can close the poll. So I think that must have closed now, or be just about closing. And interesting to see how important people think investors are. I suppose not surprising since you've come onto this event, but that is very interesting, and the very important role of regulation, which Sarah will be talking about later. I'm also just interested about the point about employees, just anecdotally, because I was on a roundtable discussion last night with a bunch of corporate leaders, and funnily enough, they all mentioned the fact that employees are beginning to be a very important driver for their decisions, because they're taking it so seriously. So that's perhaps one for Chapter Zero to explore during 2021 as to whether that's going to become a more important driver. So then we have a second question, which is, how much do you think access to capital, both through lending and equity investments, will be influenced by your company's ESG credentials over the next 10 years? A great deal, partially, or hardly at all? Let's see what you think. Wow. I'm sure you can all see those results coming through. So it's actually quite exciting. It's a bit like election night, this. So we'll give another 10 seconds, Karen, and then close the poll.
If we don't like the results, Julie, can we file legal cases? Oh,
absolutely. Well, you can probably vote twice, vote often. What is it? Vote early, vote often. Change the results, Steve.
Are you accepting postal votes?
Only if they have hanging chads on them, I think.
That takes me back.
Sorry, that's a really old one, isn't it? But thank you. So we've closed the poll. And it's interesting because the people who voted early, at one point it was 100%, I think, on a great deal. But gradually people have, a few people have come in to say partially, and a very small percentage, 3%, saying hardly at all, which I think is interesting because it probably partly reflects the sectors that are represented in the room. And we will feed these poll results into the discussion. But I think the fact that so many of you think that this is going to be a big factor in the coming years shows how important the discussions we're having from our speakers are going to be. And I do think, I'll never be able to prove this, but that if we'd held this poll even 12 months ago, I think we'd have got a very different result. I don't think people at that point recognized how significant this issue is. So let me just briefly then, if I may, introduce Chapter Zero itself, because I know we've got lots of members on the call, which is fantastic, but we also have people who are not yet members of Chapter Zero. We are a network which was put together by non-executive directors for non-execs and chairs. So we're business people who've come at this issue because we recognized as non-execs that climate was a massive challenge for our businesses. And we felt, I think all of us who were involved in starting Chapter Zero, we felt that we weren't really well enough informed. And so we decided to put this network together and launched it in June 2019. I think it shows how interested our community is in this topic, that we now have well over 1,000 members. We have over half the FTSE 100 companies have got board members who are members of Chapter Zero. And what we do is to provide events like this one, toolkits. There are a whole range of toolkits on our website, which are all downloadable by anyone, whether they're a member or not. Everything we've done has been pro bono, and this is a free network with free events. So it's very open to people to join, and specifically focused on this non-executive chair community. We're part of a global network, which has made it even more exciting. The World Economic Forum initiated a network of the idea of having networks of non-execs around the world engaged with this topic. And the reason for that was that we make up the majority of seats in the boardroom. If we don't get the whole board focused on this issue, it's very hard for the executives to bring forward the changes that they need to make to build resilience, to deal with proper reporting, to create strategies for their role in the net zero transition. You need the whole board behind that and informed to have the debate around it. So we've got sort of sister chapters, if I can call them that, developing in 18 other countries around the world, which is exciting. In fact, one of our toolkits has been translated into Russian, which was quite interesting to see. And we are, as Chapter Zero in the UK, supported by some of the chairs of some of our largest UK listed companies. We're hosted through Cambridge University, through one of the colleges, Hughes Hall, and we partner with the CBI, the ICAW, the Carbon Trust, and the Royal Institution. So that is Chapter Zero. And I'm very proud to say that if you stick Chapter Zero into Google, we come up at the top, so you don't actually even have to know the web address. So please have a look at our website. Please use the tools. I can tell you a bit more about them, or you can contact the Chapter Zero team to get that information. And I'm delighted to have been the founder, one of the founders, and to now chair our Chapter Zero steering committee. So I think we now move on to the substance of the day, if we may. And can we start with you, David? I know the London Stock Exchange is very actively involved in this topic. And so we're delighted to get your take on what our board members should be thinking about.
Great. Well, thank you very much, Julie. I was going to make three points I think are going to be kind of relevant for the audience here. The first point I wanted to make was that there is an incredible change taking place across the investment industry, and that's affecting all parts of it, including index investments as well. I mean, back when I joined FTSE back in 2002, this was a pretty niche area, small number of kind of ethical retail funds. Institutional investors weren't really interested. Today, it's completely different. As some people might be aware, you get some very big figures here. $30 trillion dollars of assets now take some kind of sustainable investment approach into account. That's about a third of professionally managed assets. That's projected to be about, to get over 50% by 2025. And what's driven this has been asset owners, so the big pension funds and the sovereign wealth funds, really wanting to try and integrate this across all of their investments. And it's been them pushing effectively the asset managers to really sit up. As asset managers have lost mandates on this basis or won them, this has led to incredible changes across asset managers as well. And as it hasn't reached passive until more recently. So index funds have still typically followed broad benchmarks, but over the last few years, this has really started to shift as well. It's reflected, we do a survey every year of asset owners. And one of the questions we ask is to what extent they integrate ESG. And this has shifted over the years. This is particularly looks at integrating ESG into index funds. So this is no longer a small part of the market. This is the market. So 72% globally, this is of 140 asset owners, said that they've either implemented or are looking to implement into their index funds. That's higher in Europe, 85%, but it's a majority in the US, 63%. And following the election there, we're going to see that go much further, I think, with the Biden administration. This also reflected in our own experience. Now, a majority of new index mandates, institutional index mandates in Europe, now want to incorporate ESG and often climate. Climate's usually the main piece of this. This isn't just the public pension funds. This is increasingly the corporate pension funds. One of the first movers here 3-4 years ago was HSBC bank pension funds, who, for their default option for their defined contribution scheme, we took on a climate tilted index rather than a broad market one. So I think it brings me on to the second point, which is that the world of index investing and passive investing is changing hugely, and most companies have got no idea that this is taking place. To give you a sense of what this really means, is this is typically taking very kind of broad benchmarks and then applying a range of climate factors to overweight and underweight securities, depending on how well positioned they are on climate. So the kinds of things we're looking at, things like carbon emissions intensity relative to sectors. We're looking at exposure to fossil fuels, to the kind of, there's a lot of debate about stranded assets, exposure to green industries relevant across all sectors. What level of revenues from solution products and services. This is looking at what kind of climate strategies companies have got, and what kind of forward-looking targets. How well aligned are they going to hit the kinds of emission reductions over time that we need to see to get down to the level of emissions to achieve no more than 2 degrees of warming. So there's a whole variety of metrics we're using, but often companies are not disclosing the right information. And often what that means is that investors will assume the worst. So it's really important to disclose. There's also, I think, this disconnect between the asset owners and investors. Asset owners and the corporate issuers. And I think there's a real understanding about what's happening here. So there's often a real kind of view that a small number of sell-side analysts really represent the whole of the investment chain. And obviously they can be very important, particularly for the active investors. But these index funds, which represent a very large proportion of institutional investments, these will be tilted on the basis of data that's disclosed through annual reports, sustainability reports. And I think most companies have got no idea really where that information is going. And that is influential. It is affecting investment flows. So it really just brings me on to the third final point, which is that it's just so important for boards to understand the level of change that's taking place here. This isn't just about oil, gas, and mining sector, as important as everything that's going on there. But I think the visibility there is very high, and there's a high level of engagement with investors on it. But this is relevant across industries. And companies need to be proactive on this agenda and to really set out what their strategies are, how they're managing these risks. what we're doing at London Stock Exchange Group, because we kind of sit between these worlds. On one hand, we're supporting investors with the kind of tools and the data. We're also supporting issuers who are trying to navigate this. We'll be bringing, we're planning to bring a lot of tools for companies over the next year ahead of COP26 in November. We're also doing some working with exchanges around the world to develop consistent guidance on climate reporting based on TCFD, that's the Task Force on Climate Related Financial Disclosure. You're probably aware that there's obviously regulation which will be moving into place here as well in the UK and elsewhere, but I think exchanges can help issuers understand this, navigate it, and start reporting on this more quickly. So with that, let me hand over to Sarah Breeden. Sarah.
Brilliant. Thanks, David. And I'm going to do three things in my remarks today, picking up actually on many of the things you've already mentioned. I'll explain why climate change matters to the Bank of England and to everybody on this call, given our responsibilities for financial risk. I'll explain what we're doing about it. And I'll end on what our actions as regulators might mean for all of you. And then I'll pass over to Steve. Now, we all know that climate change matters for the environment and for our planet. But what's clear now, even if it wasn't 5 years ago, is that climate change creates financial risks that matter for businesses, i.e. all of you, and for the safety and soundness of banks and insurers and the stability of the financial system as a whole, i.e. me. Now, these risks arise from the physical risk of our planet getting hotter, floods, wildfires, the rise in the sea level, and they also arise from transition risks, the changes in government policy, technology, and consumer preference that move our emissions pathway towards one that's consistent with net zero. But I do want to underline the point that David just made, that this need to transition is economy-wide. It affects the users as well as the producers of energy. Transition risk is not just an issue for fossil fuel companies with unburnable carbon. It matters for transportation, agriculture, real estate, industry, even sovereigns. Now, our view at the bank is that these risks have got distinctive characteristics that require a different approach if we're to manage them well. And that's why we at the Bank of England are so very focused on them. First, these risks are far-reaching in their breadth and in their magnitude. They're going to affect all agents in the economy, all sectors, all geographies. Their impact is going to be correlated, irreversible, non-linear. And so from the point of view of a financial institution and the financial system, they're going to occur on a much greater scale than other risks. Climate is perhaps the ultimate systemic risk, and that's why I care about it a lot. Secondly, these risks are simultaneously uncertain and yet totally foreseeable. I can't tell you now exactly what combination of physical and transition risk we're going to see, but I can say with absolute certainty that either we carry on the current emissions pathway and face physical risks, or we change the pathway and we face transition risks. And we cannot let that uncertainty about what will happen lead to inaction and inertia. Instead, we all need to find different ways of managing the risks. And then third, and for me, this is absolutely key, the size and the balance of those future risks are going to be determined by the actions we take now. That's because once it's clear that we want to reduce the physical risk from climate change, it's already too late to do so. And of course, the longer that meaningful adjustment is delayed, the more disruptive that transition will be. That's the tragedy of the horizon, and is why we all need to stretch our horizons and think not just about the consequences of decisions today for the next couple of years, but instead to look much further out, perhaps decades. So that's where we come in. How do we get the financial system to manage this far-reaching, uncertain yet totally foreseeable risk that requires action today? Two things. We need to green finance by transforming reporting and risk management so that every financial decision takes the risk from climate change into account. And secondly, we need to finance green through innovation and investment choices and drive change and support an orderly transition to net zero. And that first point, greening finance, is where my world has got the potential to affect yours. To green finance, it's fundamental that we get two things right: reporting and risk management. As David described, we've got a go-to framework for companies to report on climate-related financial risks in the TCFD. And TCFD has got huge support, which is great. However, the quantity and the quality of those disclosures is not yet good enough. Climate change is a risk we see looking forwards, not looking backwards. And so that means that disclosure has got to move from the static to the strategic, and it needs to use scenario analysis to help us better size future risks. I'm sure you will all know that the UK government has just announced that the UK will make TCFD aligned disclosures mandatory across the economy by 2025, with much of the action occurring in the early years. And this has got the potential to be a huge stride in the right direction towards delivering consistent, comparable, comprehensive, decision-useful climate disclosures. It will allow investors and businesses to better capture the financial impacts of their exposures to climate change, and so to price climate risks more accurately. It's a vitally important step. Get your heads around it now. In addition to better reporting, we need to transform risk management at the level of the firm and at the level of the system. On the former, the Bank of England has said that the banks and insurers we supervise need to embed our supervisory expectations for management of climate-related financial risk by the end of 2021. Those expectations cover governance, risk management, scenario analysis, and disclosure. And they're designed to ensure that those financial firms take a strategic and forward-looking view of climate risk, embedded in business as usual risk management, but grounded in the long-term financial interests of the firm. And recognizing that this is an unprecedented challenge, we've set up the Climate Financial Risk Forum. David and Steve's institutions are both involved in it. And the Climate Financial Risk Forum produces practical guides that enable financial firms and indeed others to manage these financial risks. So I encourage you to have a look at those materials. They may be useful for you too. In addition, we at the Bank of England need to consider these risks at the level of the system. We recently announced that our climate stress test exercise is going to be launched in the middle of next year. That exercise is going to do three things. First, use scenario analysis to shine a light on currently opaque risks. Second, to highlight where firms and their customers' business models need to change. And third, to build firms' risk management capabilities and prompt engagement with you on the climate risks that you face. We're going to look ahead decades to make sure we all stretch our horizons. And we'll use not one, but three scenarios to explore both physical and transition risks, including one on a path to a 3.5-degree world and another representing a late and disorderly transition to net zero. So if you're exposed to a hot world or sharply rising carbon prices, we and your financiers will see that risk. As we do this, we'll be using scenarios produced by the NGFS, the Network for the Greening of the Financial System, a group of more than 70 central banks and supervisors from around the globe who work together to ensure all financial institutions are managing these risks well. And more than 15 of us are using these scenarios to identify risks in our financial system. So it's not just UK financial institutions that's doing this, it's globally as well. And you can use these scenarios too to better understand the risks in your business. Now, if your financiers are asking you about your risks, your plan for managing these risks, it is likely that your access to and the pricing of finance may change. So before they ask you, ask yourselves, use our toolkit to do so. Our stress test is going to help banks and insurers realise if investments that look safe on a backward look are existentially risky given future climate risks. And indeed, if investments that look speculative in the past might look safer in the context of a transition to net zero. Steve, that seems an appropriate time to hand over to you.
Sarah, thank you. Just brilliant as ever to listen to you and David expose exactly why it is that businesses should be doing more on this, and why the Bank of England and the London Stock Exchange has done so much in recent years. So what I want to do, like both of you, I also want to have three broad sections to my comments. The first section is really a build on what David was saying there about the phenomenal change, the incredible pace of change that David picked up. I want to give a sense to everyone here about where that's come from and just how exciting it is and just how much it's changed, because I think it's at that point that we start to have hope that we will be able to deal with this problem, because the problem is enormous and it is real. And if we'd had this debate even maybe 6 years ago, just before the Paris Agreement, I think we'd have all had to fight the conversation around whether the science is true or not. And let's be honest, at least in Europe, we're a long way beyond. Is the climate changing, and if so, is it anthropogenic? We're all recognizing it has. We've all recognized that it is anthropogenic, and we've all endorsed, if you like, the work of the Intergovernmental Panel on Climate Change, which are the world's best scientists looking at this problem. So we're beyond the science. First thing I want to talk about is that exciting pace of change. Second, Julie has asked me to talk about the view of investors. What are investors looking for? And as a sneak preview on what I'll be saying, I think investors are not a homogeneous group. They're various different communities. And I think in understanding those different communities, as David was saying, the index community has its own set of questions. And it's absolutely right that the vast majority of companies have no idea what those questions are. And it is the role of, I think, the non-execs to force the company to think about these. So we also need to think about value and growth investors and other forms of investors. I'll talk a bit about that. And then in closing, it's going to be about practical action. What can non-execs do? And in fact, if I have one plea to you all, please think about this. What one thing will you do different following this session? Ideally, what 10 things will you do differently following this session, because it's that big? But at least go away with one action that you will take. Take something away from this and do it, because this is a big challenge. It's a collective action problem, and we need to share the duty of doing what we can. It's not just a challenge for the stock exchange. It's not just a challenge for regulators. It's not just a challenge for insurers. It's all of us. We all are exposed in different ways. We all have to do something to deal with this problem. So where's it coming from, this incredible pace of change? Well, I think we can point to different things. I'm going to choose the Paris Agreement. Incredible document. Probably would not be signed if it were brought to the UN General Assembly today because of the politics since 2015. However, an incredible moment. 2015, two massive documents were signed, the Paris Agreement and the UN Sustainable Development Goals. They were both ratified faster than any other UN agreement, particularly the Paris Agreement. I was in the room when Biden, the vice president at the time, ratified the Paris Agreement with his granddaughter on his lap. It was an incredible experience to be there within 4 months of the Paris Agreement originally being drafted. As I say, incredibly fast ratification. That document, the Paris Agreement, sets out an amazing political vision, amazing that so many countries signed it, a series of plans called nationally determined contributions, and then a process, the Conference of Parties, the COP as it's called, which has actually been around since 1992. So COP26 hosted in the UK. It will cause an enormous amount of more policy. Sarah's articulated a few. An enormous amount of more policies will be coming through, not just from the bank, but also the FCA, I'm sure. There'll be stuff coming out from BEIS and DEFRA. There'll be a whole raft of things. So the UK can continue to maintain its leadership in this area on the global stage. The Paris Agreement, though, then generated an environment within which we've now seen dozens, I think it's over 60 now, central bank governors come together for the Network for Greening the Financial System, led by Mark Carney as the governor for the Bank of England. He did so much. NGFS has also been led by France, by the Dutch Central Bank and others. We've also, So the network, there's the finance ministers group, the finance ministers for climate change, and the network for greening the financial system. Both of them have got dozens and dozens of governors and finance ministers within it. As Sarah articulated, the FSB has created this task force in climate related financial disclosure, which actually coined this threefold paradigm: physical risk, transition risk, and litigation risk. And it's the challenge of our lifetime is moving our economy in a way that doesn't expose it to the extreme physical risks, which it is currently heading towards, and also doesn't fall into the jaws of the transition risk. We've got to harness markets so that it manages our transition in a way that avoids both of those extreme scenarios. The unfortunate reality today, and David, I hope you'll forgive me, I'm not blaming the London Stock Exchange for this fact, but possibly the scariest figure I learned when we were doing our TCFD reports, and we're now on our fifth, we're working on our fifth, was when we discovered that the London Stock Exchange embedded global warming potential was 3.8 degrees. It's not David's fault. It's the companies that are listed on the exchange. If you were to use all the proven and probable reserves and the other forms of energy that are listed there, then we will head much more rapidly towards 4 degrees than the 1.5 degree scenario of the Paris Agreement. There are any number of reasons why we should care about that. The world's coral reefs will effectively have all bleached. The world's lungs, the rainforests will be collapsing. We will see about 75% of the world's population no longer able to live where they do today without air conditioning. So that huge amount of migration is actually where we're heading business as usual. That's why we've seen now over 2,000 pieces of policy and regulation around the world. Some countries have more than 30 to try and internalize the externality, as it's called. So this pace of change, not just these policies and regulation, but also litigation. I learned recently that there's been over 1,500 separate legal cases now in the last few years on climate change. Whatever you do, if you're non-executive directors, make sure your business is not exposed to that litigation risk. Make sure you are doing something about this problem. Make sure you are governing it and that you've got a clear articulation should the lawyers come. And they really may. I mean, as an insurance business, our directors and officers' liability insurance and the extent to which it underwrites this kind of risk is an issue for us. So if it's an issue for us and you have D&O, you need to think about that too. So that's the pace of change and where it's coming from. Huge policy shift, phenomenal agreement within the Paris Agreement. However, it doesn't yet set out a vision, a plan, and a process for finance. That I'm expecting to see at COP26. And under Mark Carney's continuing leadership on this agenda, he's advising the UN, he's advising the UK, and there are any number of, I think, phenomenal ideas currently emerging that we could make happen at COP26. More about that perhaps under Q&A. So that's about the pace of change. In terms of investor interests, there are some that just don't care about this. Let's just put that out there. If you're an algorithmic trader, you don't even know what the ticker means in terms of the company name, let alone read the report and accounts, let alone read the sell side notes. So there's the algo traders, they don't care about this. Or the technical analysts, the chartists, they won't care about this. Your value investors will care about the dividend protection and ensure that the business can continue indefinitely in the way that it is to generate sustainable income. Think about them. Growth investors are looking for obviously improvement in share price. That's where, and so they want to know that the business model is sustainable over decades too, certainly over their investment time horizon, which has already been articulated is tragically normally only 3 years at best. In fact, most DCFs most discount cash flow analyses only go out 3 years as well, which is another part of the tragedy. And incidentally, Sarah, I don't think we just manage change or greening finance by changing reporting and changing risk management. We've got to change the incentives. We've got to change the valuation models. We've got to internalize the externality through a whole raft of regulations so that it's actually on the balance sheet. It's only when it hits the cash flows that it becomes relevant to investors. And that 2,000 set of regulations and policies that I refer to, that's what that is doing, but not yet enough. So that's a little bit about the interest of value, growth, and algo traders. The passive funds, if you take one thing away from what David said as non-execs, ask your IR teams, have they analyzed what the various indices from a tilted perspective are looking for? And is your company disclosing them? And how does it perform? Do a very practical exercise. Ask your investor relations teams, have they got any visibility on this world of ESG? Have they thought through the top 25 investors? Have they looked to see what their policies and processes are in this framework? Have they looked at their voting policy as well? Because it's the very big long-term owners like Aviva who has been embedding like climate change in our voting policy for 2 decades. To what extent are the noise and the signals that you're getting from us as long-term owners and the sovereign wealth funds like Norges and Temasek, if they're on your book, if they're part of your ownership, look at their policy framework, because that's where the world is heading. Long-term owners who get physical risk are absolutely petrified. And by the way, the physical risk gets most acute beyond 2050. When we worked with the Economist Intelligence Unit in 2015, it was we modeled out to the end of the century, because when we modeled out to 2050, physical risk wasn't that bad. Maybe 20% of GDP, maybe 30 to 40% of the actual kind of stock of the manageable assets. But when you get to the end of the century, beyond 2070 and 80, those physical risks become existential for our business. Existential for our business. And towards the end of the century, if we hit business as usual, we are at a point where the runaway impacts of climate change could wipe out civilization, not life on Earth, but civilization. This is why we need to be worried. So non-execs, get your IR teams to review what your book are looking for, your top 25 shareholders. Look at the way that credit rating agencies are modeling climate risk. Look at the way that proxy voting agencies are looking at your director re-election, your board pay, and of course your disclosure, and make sure IR is sophisticated on ESG. The majority of them are not. Honourable exceptions would include BP, for whom we are very proud to be supporting their work on the transition. So that's a little bit about where it's all coming from and some practical recommendations for non-execs, and I've covered as well the investor interests. And in handing back to Julie, I will again reiterate, what 1 to 10 things are you going to do differently following today as non-execs? Because this is big. It is the challenge of our lifetime. Julie, back to you.
Thank you, and thank you to all our speakers for setting that out so clearly. If we didn't understand the imperative going into this session, we certainly do now. I'm particularly interested in the points about the drive from asset owners and pension funds to lead this, because I think that's been something that's been a little slow in happening, and we're hoping that it will people will take it more seriously going forward on default funds particularly. This is the biggest, as you say, existential risk that we face. But I also think that we need to be optimistic. I have to look back over the 12 months and think how much has changed just in that period on this topic. The focus, the press coverage, the regulation and reporting frameworks, the interest of investors. It's really escalated beyond, I think, anybody's expectation. And on the back of that, we in business are actually pretty good at responding to challenges and changing our business models and transforming our operations. We've done it many, many times over the decades. And I feel very strongly that this is within our grasp. Nigel Topping, who leads the business side of the COP planning, is always saying, you know, we can do this. And I think that action orientation is something maybe we can bring into the Q&A. So we've now just got a couple more poll questions. And the first question, so if you would, in the audience, open your Slido panel again, in case you've closed it. The first question is really one for our Chapter Zero benefit, if you like, because we want to take the temperature of how far companies in the room are going with their planning. And so the questions are, let me get them up, you can see them. Has your largest company announced a net zero target with short-term milestones agreed? So is there a target out there? Yes. The ambition has been announced, but the short-term milestones are not yet in place. So the plan is not yet there, but the pledge is. We haven't announced publicly because we want to agree the milestones first, or our board hasn't really formed a view. Our discussions have not been impactful. So let's just see where we get to on the votes, which I'm trying to look at, and you can see them in front of you as well. So I think we can close the poll. It seems to have steadied, Karen. We can probably close the poll now. So 40% of you are saying that the discussions have not yet led to impactful decisions on this topic, which I think is a cause for concern for those of us in this room, because companies throughout the world are now setting these ambitions. 30% though have got a plan and an ambition in place and public, which is probably 20% more than if we'd asked this question a year ago. So that's very helpful. Can we just move on to the next question, which our panelists actually asked us to put up, because they're interested to know what are the barriers to tackling this issue. They can talk about what we need to do, but they want to know why in some cases we're not as fast as we maybe would like to be. So can we just get a take on that one? And we'll give it 10 more seconds, Karen, and then we'll close the poll. Okay, so if we close the poll off now, I think that's very helpful to understand this this issue better, because lack of understanding is coming out in 50% of the responses, and of the strategic implications in particular. And I think from our Chapter Zero experience that is absolutely understandable. I mean, we are finding, as we have these sessions, and we're now running a lot of them, and roundtable discussions with board members and chairs, we're finding that that people do want to know more and understand better, but the really deep analysis that needs to go into preparing proper disclosures, having a significant debate around these topics, coming up with a strategy that takes account of both transition risk and physical risk. It's not a trivial exercise. It requires a lot of data that companies haven't necessarily collected, and some very skillful scenario work. So I'm not surprised at that, but it does give us all a challenge, because how do we get ourselves up to speed? How do we get the appropriate inputs, and how do we get really good scenario analysis going on, so that we can get past that? And when we do that that poll in 6 months' time, lack of understanding is not the key element. So let's now turn to some questions, and we have a number coming in from the audience, and we have a number that we want to pick up with different panelists. So there's one I can see here on the screen, which is COP26 is a year away. Sorry, I should have said I will take, Steve, I'll ask you to pick this one up first, and then maybe move to Sarah. COP26 is a year away. What goals, targets can we hit before then? And what are the best mechanics to do so?
It's not a year. It's 338 days. And it's massively important. And the reason why it matters so much is that I think so many of us could be doing so much before then. And we've been given another year by the unfortunate circumstances that we found ourselves in this year with the coronavirus. We need to make that year work. We need to increase our ambition to be fit for the challenge. And I think there's nothing holding people back from doing a TCFD report now. If they aren't, they damn well should, because that's where the regulation is heading. Ideally, they should put that to the vote. I think it would be wonderful to start seeing some kind of oversight from stewardship happening. It would be great if you can do a fully compliant TCFD report and not endorse the Paris Agreement. I'd like to see an endorsement of the Paris Agreement, and also science-based targets, which is an initiative in itself looking to see net zero, which of course Chapter Zero is a fan of. Net zero is essentially making sure, of course, that by the midpoint of this century, emissions are at least extracted by an equal, if not greater amount by things like carbon capture and storage. Net zero doesn't mean there are no emissions. It means there's also CCS at a scale that's unprecedented. So if you're a business that generates a lot of scope 3 emissions, look at carbon capture and storage. Look at how you can be net zero before 2050. Try and set targets. See if your business can set targets that go to maybe 2030. It's possible, maybe. It's very difficult for insurance companies that own everything else almost to do that, but even we are looking at it. So those are things that I would recommend. But I think we've started to see a new paradigm evolve around transition plans. If you look at your TCFD report, those of you that have done them, ideally you've got one scenario that's 1.5 degrees. What happens when you make that your business plan? Make that your business plan and now focus on the transition towards it and articulate how you're going to do that. The likes of BP and Shell and BHP and other massive businesses, if they can take on that challenge, then I'm pretty sure that everyone watching can. I hope that answers your question, Julie. Oh, and the COP26 opportunity to reshape markets is huge. And I really hope we get an opportunity to go into that area under Q&A in some detail. But back to you, Julie.
Thank you. Sarah, do you have thoughts about prior to COP26, what we can do?
I think Steve has covered it brilliantly. Understand your risk, disclose your risk, have a plan to reduce that risk. It's as simple as that.
It's as simple
to say.
Yes, simple to say.
Hard to do.
Hard to do.
But if we don't start having a go, we're making those future risks bigger. We have to start now. That is, as Steve put it so beautifully, don't wait for COP. Start now. It is tough, but it's better to be roughly right now, not precisely right when it's too late.
Maybe
and
I could
sorry,
as well,
David.
Julie, in that I think what would be fantastic ahead of COP would be seeing kind of net zero ambitions across companies and across investors, and to see those quite well joined up. And also, maybe I just wanted to pick up on a slightly provocative comment from Steve earlier on in terms of the 3.8 degrees of London Stock Exchange.
I hope you would, David.
I thought it was worth picking up and linking it actually with this point, which is, I mean, well, firstly, there's a whole variety of different methodologies to try and measure temperature. The key thing is looking at forward strategies of each individual company. Now, if you look at kind of the marketplace generally and global economy, clearly we're not currently aligned with 2 degrees. And so all, whether that's large investor portfolios or whether that's those companies listed on exchanges are not going to be in line with it. However, if we get the right forward targets, if companies can set those net zero targets, then actually the global economy starts to shift. And actually those kinds of assessments should then start saying that things are in line with 2 degrees. But I just wanted to link those up.
I think that's very helpful, David. And ideally we're looking, as Steve says, at the 1.5 target, which is an interesting scenario for our board members to play out. And I was interested to hear on one of these sessions just last week, which I hadn't realized, I probably should, that even at 1.5 degrees, the physical impacts of climate change are quite severe. So even when companies are looking at how they achieve their net zero plans, they also need to be looking at the physical risks associated with even the optimistic scenario. And the numbers of plans are coming out daily. I mean, we wouldn't have, I think, expected nearly as many to be announced as have been in the last couple of months, which is fantastic. And just a final point from me on that I believe that Mark Carney has called for a vote on companies' climate strategies, which I think is a really interesting notion. I think it's probably quite hard for us to know how to respond to it. So I'm not saying it's a good or bad thing, but it certainly would set the cat amongst the proverbial pigeons, I think, if we had to come up with strategies that get that vote. So that's very helpful from the panel. We've got a number of questions coming in around asset allocation, moving of funds away from companies that are not haven't got ambitious enough pathways or haven't taken climate into account. David, I think I'll ask you to kick us off on this one. You know, there is the Church of England Pension Fund, I believe, has recently moved its assets away from companies that it doesn't feel are taking climate change sufficiently into account. And are we starting to see more shifts of capital to low carbon companies? And when you comment on that, I wondered if you'd like to talk to us a bit about the Transition Pathways Initiative and climate indices generally, because I know it's something that you are particularly keen to share with our audience.
Yeah, so thank you, Julie. I mean, as I mentioned earlier on, the trend here is phenomenal. But when you think about what is the actual impact of this, yes, there's been a huge number of index funds which are starting to account for climate factors within the weighting of the securities. But you know, how much has to shift before it affects cost of capital? I mean, it'll be starting to happen, but the impact, given that many companies don't understand that this is happening, there's a lack potentially of impact, and many asset owners, many investors want to have impact through their investment. And one key way is through engagement. And you often hear from companies and saying that they'll get an ESG engagement team talking to them, and they'll have a completely different discussion with them than they will do with the portfolio managers. Now, what I'm quite excited about is this initiative you mentioned, the Transition Pathway Initiative, TPI, which I think kind of breaks through a lot of this, and also I think can transform some of the index engagement. So TPI, just to explain what it is it was set up by a number of asset owners. It's a partnership. Particularly, I should give a call out to Church of England and the Environment Agency Pension Fund, part of Brunel, for their leadership, and they co-chair it as well. But it's got a range of other asset owners from around the world now as part of it as well. Works with the London School of Economics, the Grantham Institute, to kind of really strong academic rigor behind all of this. The PRI is another partner, and also ourselves as a data partner. We made a decision to make all of our data publicly available on climate through the TPI and through the Grantham Institute. So, and what it does is there's two parts. There's a management quality score, and then there's a carbon performance score. The management quality is all based off TCFD data points, so very aligned to everything we've been talking about today. It's very simple, puts companies on a ladder, depending on how good their management quality is. And you can only go up to the next step if you meet certain extra indicators. So, have you got kind of senior accountability? Are you starting to measure and report it? Are you setting the right kinds of targets? Are you linking this to executive remuneration? And you go up the steps. The other part is the carbon performance, which is, are you aligned with your targets aligned with 1.5 degrees, 2 degrees, or is it not aligned? And so we use these measures to overweight and underweight companies. I should say that TPI itself is a kind of an engagement initiative, about 20 trillion behind it. It also feeds into CA 100 plus, the Climate Action 100 plus, biggest ever global engagement initiative. And quite nicely, these two things join together. So this is being used to engage companies. And what's quite powerful is using that within index design, as that means that the assets then follow. So as a company goes up these steps, as they respond to engagement and improve, their weight in these indexes and associated portfolios goes up. So the index investment supports the engagement, and I think is very powerful. It makes it much more transparent to companies. They can understand how they're being asked to do these things, and the investment follows. So that's, I think, I hope that that some of the older indexes don't necessarily include TPI. We're certainly talking to those investors who are using a variety of different climate indexes to see if they would like to also include these TPI measures, as we think that can help align this.
Thank you, David. Sarah, somebody's directed a question to you. They're obviously feeling quite provocative, so I'm going to read it as it's written. It says, how do we get HM Treasury's net zero review to cover adaptation costs? Currently out of scope, ? Nature is sending us invoices. I like that phrase, by the way. I'll borrow that one. HMT seems happy to bin them. Do you have any comments?
So let me say two things in response to that. First, I think it's really important that we focus on climate change just because of the particular challenges that we have with climate change, because there's a finite carbon budget and we need to start taking action now to make sure that that carbon budget doesn't get filled and that we transition in as orderly way as possible. So there's what I like to call a 20-year control lag with climate change. That means that is the urgent thing. So in that sense, I want us all to focus on net zero now. But of course, the rest of nature matters as well. And that's why Treasury have got the Dasgupta review in hand, and it will come out soon. And so I'm hopeful that having been grounded in climate, we will then broaden into broader nature issues.
Thank you. Steve, there's one here that I thought you might help us with, and maybe Sarah will have a comment too. What does a financial system look like which can mobilize capital at scale to deliver the solutions we need and not just manage the risk to existing value? Do you want to take that one?
Okay. I've got to be honest. I think a lot of what appears currently in the Treasury's green finance strategy is beginning to do a little bit more than tinker around the edges, but it's not going to the core of the problem. It's not going to the core of the challenge. Core to the challenge is investor time horizons. If you only value out 3 years and then you assume all things will continue to grow forever, as often people do in a discount cash flow analysis, then you're completely ignoring these future hits into 2100. So not doing DCF like that would be important. Discounting future generations is also core to a DCF, and so policymakers need to recognize that the market price is tragic in many ways in terms of this problem. The tragedy of horizons is kind of core at valuation. I think also, if you get really kind of arcane about this, modern portfolio theory was created in 1952 by a gentleman that has great grandchildren. It is not modern. And we need to understand that most modern forms of portfolio management continue with the assumptions that were originally made around you can assume away this one planet boundary condition. And you can't, because there are feedback loops. Modern portfolio theory has a risk and return efficient portfolio frontier, as it's called. Many of you will have studied it years ago in economics. That portfolio frontier moves in and out depending on how those returns are generated. And Markowitz's original theory doesn't respect or reflect that. I think we need to look at the core of finance. We need to recognize that even with all perfect disclosure and perfect risk management, it's still short term, the way that markets work. That's why we actually need the externalities internalized in the jargon. We need to make sure that you've got a contingent valuation of the costs to the environment and society that companies create, and that the role of other regulators is to internalize that externality onto the balance sheet. Because we can prepare finance as much as we like, but until it actually hits the cash flows, it's not really going to move it much. However, we can still do a lot more than is even still within the green finance strategy of the Treasury without all of that internalizing. One of the most important bits that's been missing, and someone's sent me a note about this today from the Institute for Chartered Accountants following this conversation, Solvency II. Post-Brexit, we have an opportunity to rewrite a lot of the regulations on finance and improve them. We need to shine a light on this through a climate lens and look at the fact that Pillar 1 currently tips even insurance company money into old economy assets. And that's not clever, that's not prudent. And it's supposed to be prudential regulation. It just so happens that most of the companies that come to the market for bonds, investments, corporate bonds, are oil and gas, mining, and you also have autos, as well as a few other sectors like telcos and banks. But those first three, if you're tipping the market towards those sectors, it's supposed to be market neutral, but those sectors happen to be the most significant acquirers of corporate bonds. You're reducing the cost of capital of the very companies that are actually increasing physical risk. I know this is an arcane point now, but we need to really understand the business models, the personal incentives, and the regulatory infrastructure, and how it's exacerbating short-termism and enhancing physical risks, and rethink markets. This isn't trivial, this isn't easy, this isn't something we can just do with a TCFD report. This is really fundamental rethinking of markets. So Judy, those are just a few ideas of how we go beyond the window dressing that I currently see.
Thank you
Can
very
I
much.
add to that, Julie?
Yes.
I think a thing that we are exploring, that financial institutions will be exploring, and that I encourage all of those on the call today to explore, is to think about what carbon price am I assuming in the decisions that I'm making today. And if I'm not putting one in, then in effect, I'm assuming that we're on a path to 3.5, 4 degrees. And instead, if what I want to do is put my business, my investments, the health of my financial institution, whether a bank or an insurer, on a path that is sustainable, what carbon price should I be assuming in my investment decisions? The scenario, the stress test that I mentioned, the scenarios that the NGFS have put out there have got forward paths for carbon prices in them that are consistent with temperature outcomes and different transition pathways. We can build those into our thinking now. And to Steve's point, that's something we'll be thinking about, how we can build that into our prudential framework. At the moment, it's a bit tricky because we know the destination that the government wants, it's net zero, but we're not quite sure of the pathway to get there. But what we do know is the sooner we start incorporating that into our investment decisions, the smoother the path will be to get there. That's for us, that's for financial institutions, and it's for all companies in the real economy too.
And to further build on that, if I may, Julie, thank you so much for that point, Sarah. I could not agree with you more. The EU emissions trading scheme, if you go back a few decades, there's been a lot of volatility, but it's beginning to get more material. It's about 25 euros. Now, if you forecast out to where it needs to be to manage the physical risk, you're getting a long way north of 100 euros very soon. That's going to be material to a large number of the viewers. And whilst it's okay for us to do a scenario that assumes we're going to get there, it only actually hits valuation. It only changes portfolios at scale when it really does get there, when you really do have a carbon price that is internalizing the externality. That is how markets should work. To properly, markets are supposed to be there for society and our well-being and welfare. Climate change is the world's biggest market failure. It has not been sufficient. Markets have not been corrected enough to lead to optimal welfare. That's where environmental economics hits sustainable finance, hits the real world. I think we need to be modeling 150 euros.
Yeah.
And I think we need a system that prices it at 250 in the next 10 years. And I think that's a huge transition. So if as non-executive directors, if you haven't looked at what that does to your balance sheet, tell your finance team to have a look and tell them to work with investor relations and the corporate responsibility team so it's a proper model.
That's really interesting. I mean, some of the people on the call would have been on a transition risk event that we held a couple of weeks ago. And one of the scenarios in that was had a $200 carbon price in it. And it was very interesting to see the response from the audience to that. So,
Julie, let me
yes.
just throw one thing in. Our disorderly scenario will have the carbon price at $700. So, you know, the sooner we start changing, the sooner, I'm afraid so.
Yeah, so it doesn't matter now.
The sooner we start changing, the sooner we can make the shift in a low risk way.
Absolutely.
If we have $1 trillion cost at the end of the century, it gets discounted to about 200 million today. No one would do that sensibly, would they? But that the net present value of $1 trillion at the end of the year is only a few hundred million today. So that's the tragedy. This discounting point means that we ignore future generations, and physical risk becomes less important to us than transition risk. And as a TCFD, I think we've fallen into that trap. Sorry, Julie, I'm sure you want to take the conversation somewhere else now.
Yeah,
this is big stuff.
We could talk about that for a long time, Steve, I think, couldn't we? So I'm going to go back to some of the questions that have come from the audience, and one that's a slightly different topic, David, which perhaps I could start off with you and then maybe move to Sarah on. What do you see as the biggest data gap that, if we could unlock access to it, would enable the greatest leverage? I think that's a terrific question. So what are your thoughts?
Well, that's a big one. I mean, I could go down one of the usual routes around, better carbon emissions data, better targets and forward information. But actually, I'm going to zoom in on the kind of the opportunity side, maybe. So this is a really easy one, but is a critical gap. This is creating a huge amount of industrial change. And I think actually a lot of investors don't really have visibility of it. There's changes going on in each industry. So yes, there's a lot of discussion about stranded assets, but if this could be lighting companies that are making tungsten lights, and actually, how much of their revenue is coming from LED lights now? This can be obviously auto sector, and how much is coming from electric vehicles and hybrids, which surprisingly most auto companies don't break out today. We've developed a system which we call green revenues, where we categorize 133 micro sectors of different green industries, and we try and collect data from companies that this kind of fine grain, advanced batteries, desalination technology. Investors, it's really important for investors to be able to allocate to companies which are growing their products and services, which are providing solutions. And this information is amazingly not really there. Over half the companies are not breaking out the revenue appropriately. And this is very simple. This is simply looking at your revenue segments and breaking out sub-segments where you've got green products and services. Investors really need this information. There's also going to be, we can see at the EU level with the taxonomy, and both Steve and I had some involvement here where we were very keen for the EU to come up with come up with a clear taxonomy to try and encourage better disclosure. But we'll see taxonomies being developed around the world. We'll see an important announcement from the UK in terms of a UK taxonomy. Need to be interoperable and need to not go off in completely different directions. But what we need from the companies is better. That's an area which there hasn't been much focus, and we need better revenue breakdown.
Sarah, did you have anything?
Yeah, let me add one thing. So I think we've talked about TCFD and kind of the data from companies. David's just talked through the importance of opportunities and revenue. I agree with both of those. And then I think the third really important part, and it speaks to that ding dong that Steve and I were just having, is all about what are the methodologies? What are the scenarios? How do you think about this in a way that drives the right decisions? Because this is all about not analysis, but taking different decisions that drive the right behaviors. And that's where we as central banks are doing our bit. I would really encourage you all to look at the scenarios that we have put out through the NGFS, to look at how we are proposing to do stress testing as the Bank of England, because those exercises are designed to help us all develop the methodologies and approach to managing the data to drive the right decision. So I'd take it one step beyond data to be, how do we use the data?
Thank you, that's great. I'll make this our final question so that we do keep to time. And Steve, if I may give it to you. Two things combined. First of all, people are asking, what is Aviva going to be asking its investee companies? What are they really going to be focusing on in terms of their questions? And sort of aside to that, somebody has said, how do smaller companies get the attention of climate conscious investors? I mean, I was very interested in an article in the FT couple of months ago now where it said big business isn't the problem. It's actually the huge supply chain part of business which makes up the emission problem, so that you can't just lead it from the top. You also need to create a movement through the whole supply chain and operating model. And obviously it's something that Unilever are very, excuse me, focused on. So Steve, if you wouldn't mind just telling us what the Aviva key questions are going to be, and then how does a smaller company get attention?
We've had climate in our voting policy for a long time, and all our fund managers are behind it. And that you'll find, if you're coming in to see them, or indeed the governance teams, you'll find that the focus will be on TCFD. If there isn't a report, there'll be a pretty stern question as to why not, or when is it coming. So that would be sort of the first place to start. I would also encourage people to think, and comes back to the point that Sarah and David was just discussing, what's the one data point? I'd also like to see, we'd all like to see, in fact, it's in our policy, how are climate risks embedded in board pay? How are they in incentives? So that's the second question. And then if that isn't happening, if we aren't seeing a TCFD report on a company where it's material and it's not embedded in remuneration, if performance is poor, then directors might get voted against by us. So it is important, and we have been doing that for years. That's not looking forward, that looking back, we've been doing that. So how can smaller companies get our attention? If we may already be owners of them, so it may just be pick up the phone or send us an email. If we're not on the book and there is a big source of revenue that the market isn't yet properly factoring in through the kinds of things that David was talking about, green revenues are coming, and they can tell a convincing case as to why their business is well positioned for that growth sector, we are interested owners. So give us a call. Third thing I will just briefly talk about, Julie, is COP26. Are we going to have an opportunity at the very end of this session, Julie, to just paint a little vision of what we might achieve there, or should I use this slot too? We will have. Then I will be quiet, because that is such an important thing.
You can use your final slot for that, Steve.
I shall do that, Julie. Back to you.
Thank you. So some fantastic questions, and thank you to the panel for all their interactive answers. It's good to hear people's different views and see that we're coming at this from three different perspectives, but very much with a common theme. So I think it's time really to wrap our session up. And I would return to something that I was saying a little earlier on, which is that it would be good to finish on a note of action and optimism. When you look at the progress of the last 12 months, I think it tells us that if we could achieve that sort of progress every year for the next 10 years, we would really have achieved a huge amount towards these goals. So I thought we might finish by just asking each of our speakers to just talk about what their call to action is. What's the one thing you'd really like the audience to take into their boardrooms, because this is all about getting this discussion into the boardroom, not just the individuals on the call, but their whole boards to be understanding and debating these issues. So Steve, can I start with you?
Thank you, Julie. What a brilliant session, and what a brilliant discussion. It's been huge fun, and it's been wonderful to hear David and Sarah's points, and just how much consistency there is between us, and how much of a build there's been. So I've already given a few practical suggestions to non-execs for kind of getting the investor relations team to be sophisticated on this in terms of the ownership book and proxy voting agencies, credit rating agencies. Really look behind what they're looking for and position your business accordingly. So I'm going to now, instead of talking about how you respond to the external environment, I think what we need to do is be brave and bold in changing the external environment. Be assertive in what your business can achieve in the political space in the run up to COP. Because as I mentioned, the Paris Agreement is a bold and big political vision, political process, and political set of plans. It is not a financial vision, plan, or process. We need to mobilize markets. And I think one way of doing that might be to have a private finance accord at Glasgow, requiring or requesting financial institutions to set out their own transition pathways, asking companies to do the same thing. If you sign this accord, you then ratify it by publishing your pathway, and then have a process that monitors then the annual plans that those businesses put out. I'm thinking of that process as some kind of international platform for climate finance. You could think of it as inspired by the intergovernmental group on the Intergovernmental Panel on Climate Change. Now, if we have a process that monitors the plans of these businesses and financial institutions and brings together the supply of capital with the demand for it and maps it into the country's nationally determined contributions, then we stand a very good chance of shifting the trillions a year that we need to shift. But putting that in perspective, even if it's just $1 trillion a year we need to shift, that's 4 times the whole Apollo program, plus 4 times the whole Marshall program at today's prices. So we need to get on with this. It's big. It's already been hitting markets. You've seen valuations shift. You've seen whole sectors change, particularly, for example, US coal, and nuclear, for example, in Germany. But there's huge challenges ahead of us. We are up to them. We can do this. We need to use COP26. We've built a coalition for this international platform in climate finance, and everyone is welcome to join it as we move towards COP26. So that would be, if you're going to do nothing else, join our coalition after you've joined Chapter Zero.
Thank you, Steve. And Chapter Zero is already part of your coalition, as you know. So I would really encourage people to find out more about that, because it's a very, very powerful driver of change. Sarah, would you like to give us one thing that you want the audience to go away with, or more than one, if you like?
So mine is not dissimilar to Steve's. So it's have a plan for net zero, disclose that plan, embed it and have clear steps that demonstrate how you're making progress already, and make the organization accountable for it, make not following it, including those near-term steps, have consequences, because it's only that way that we have the different decisions today that will drive us in the direction we need to go.
Thank you, Sarah. That's really clear and helpful. David, what from your perspective?
So we've talked about all of the huge potential risks, economy, businesses, but I also want to say we are going through a period of huge economic disruption, but there are massive investment and business opportunities from that as well. So I think it's embracing that, it's identifying the opportunities, and I think I wanted to finish on a positive note, but also actually there's an interconnected piece, which is company pensions as well. So that kind of connects this up. Now, obviously, the pensions for most companies will have a separate legal basis, but clearly the company and the board can have some influence there. What's important is, are they taking climate risk seriously and climate opportunity? What is the company's pension policy and approach as well? But I just wanted to kind of also thank everybody for a great discussion, and just so important at this time, and to really take advantage of the run up to COP26, and to thank Chapter Zero for organising this.
That's a great point on the pensions, David. Interestingly, it came up quite recently, and what was apparent was that even a lot of the boards who are very focused on building their net zero strategies hadn't actually connected that back into where are our pension funds being applied. So it's a sort of really interesting, it should really be part of that strategy, just as we have to deal with scope 1, scope 2 and scope 3, which is where the biggest emissions are. The pension maybe is a sort of scope 3-ish issue for us. So thank you very much to our panelists. That was a brilliant discussion, very, very helpful. I think all of us as non-execs come out of that discussion really focused on the fact that we must get a strategy in place for this. And we're not in any way dictating what the answers to that strategy are. This isn't about saying it's got to be 2030 that you'll get to net zero, it's got to be 2050. This is about boards having the right information and the right discussion to create the appropriate plans for their businesses, declaring those ambitions, but having really robust plans to implement them. And one of the things that we're very much focused on in Chapter Zero for our work going forward is the whole issue of how do you then implement these plans, because they touch everybody in a business. They touch all the threads, all the suppliers, the consumers, the staff in every part of the business. And that's a big challenge for companies to tackle. So setting the ambition and creating the plan is step 1 and 2, but then engaging the whole organization in implementing that is the heavy lifting. And that's something that we in Chapter Zero are really going to focus our efforts on, trying to support companies in building our tool sets, creating more events, so that as we approach COP and beyond, we can really get momentum behind these plans to protect the asset values for future savers and pensioners. So thank you all very, very much. Please go to the Chapter Zero website. Thank you, Steve, for saying that people should join. I do encourage everyone who is not a member of Chapter Zero, but is a non-exec or chair on this call, to join us. It's not a public commitment that you make, it's a personal commitment to become informed and engaged with this topic. So we welcome that membership, and we have an aim to try to have 2 Chapter Zero members at least on all the listed company boards by COP26 next year, so that you're never a lone voice. There will hopefully always be 2 Chapter Zero members who can engage in that boardroom discussion together. So with that, it only remains for me to thank our speakers once again. You've been a terrific team. Thank the Chapter Zero background team and the London Stock Exchange team, who put a huge amount of work into making this a smooth event, and to wish everybody on the call a very good day.